Specifically, it's for CalSTRS, not because we want to be exclusionary or anything like that. This is CalSTRS, some CalSTRS specific information we're giving. We are working on a CalPERS workshop where CalPERS itself would come out and do the presentation, or look at some other options there. But the two parts to what we're going to do today. One is a CalSTRS overview, and then we also are going to take a part two, a deeper look at tax sheltered annuities that Jim Adgar from Plan Member Services is going to help with. So want to just welcome everybody again to the SLUSD Retirement Overview. If you can only stay for part one, no problem with that, but understand there's two parts to it. It might take the full hour for Jim to go into his tax sheltered annuities deeper dive. So with that, we're going to go ahead and talk about today's presentation. And I think this is Veronica.
Okay, welcome everyone. Thank you so much for being here today and joining us for this very important informational retirement overview seminar. If you're joining us today, you have just taken the first and very important step into your financial wellness. For those of you who don't know me, my name is Veronica Sanchez. I am your Employee Benefits Specialist here at SLUSD. I have been in this position for 1.5 years, but I've been with the district for over 15 years. A bit of what I do is I administer all of the benefits for you, our district employees, benefits such as medical, dental, and vision. Usually I facilitate this information during our onboarding meetings, which is probably where I met most of you. But throughout the year, I work with you to help explain our benefit packages, benefit enrollment and eligibility during open enrollment or special enrollment periods. I also assist our soon-to-be retirees with the transition of benefits into retirement. I'm also part of the Wellness Committee, and our district has been so amazing in providing our SLUSD employees with wellness seminars and resources through the EAP program. You can find more information about the EAP program on our San Leandro website. Just kind of wanted to throw that out there. Another part of my job is getting you information on our most up-to-date list of approved benefit providers and working with you to get you connected with a financial professional to help navigate as you plan for financial wellness, which brings me to why we're here today. Dr. Collins, Assistant Superintendent of Business and Operations, has put together a CalSTRS overview presentation here for you today. Following, we will have Jim Adgar, our financial professional with Plan Member Services. And although we don't promote any financial advisor or their firm, Jim has been working with many of our SLUSD employees over the years and has a wealth of experience. He will also be presenting and sharing some of his expertise around tax sheltered annuities. But first, we will hear from Sarina Sanipatin, Assistant Superintendent of Administrative Services, and from Grazilia Ward, Director of Personal Services. So please help me welcome them and welcome Dr. Sarina.
Hi, good afternoon, everybody. Thank you for coming out and spending some time with us. We just wanted to really go over, have the opportunity to make sure that you get your questions answered. If you've been wondering about, what's the difference really between if I'm just deciding to leave the district or if I'm deciding to leave the district because I'm contemplating retiring, or when am I able to do that? And so for some of you who maybe have just started on your journey, you may not be thinking about this quite yet because it seems so far away, but we want to just be able to provide you with the information so that you can make informed choices, right, as you go through your career. So we're going to spend some time today, just going over some of the various retirement programs and breaking them down to see what those are. We'll spend a lot of time on the California State Teachers Retirement System, CalSTRS, which will point you to the direction of the resources that you can, after you're done with our workshop today, kind of go and peruse yourself and take a look at what is on their website. And then take you through, like Veronica said, through what is a tax sheltered annuity and what can it do for you, and how, if you haven't started one, where can you get the information to get that started. And then finally, just answering your questions along the way. And sometimes the information can seem overwhelming, but feel free to, you have a lot of folks here that'll help you kind of guide you through some of those questions that might have been coming up for you. So with that, I'll toss it over to our Director of Personnel Services. Ms. Ward.
There you go. Couldn't get myself off mute quick enough. Good afternoon. Welcome, everyone. Thank you for being here. Again, my name is Grizilia Ward. I am the Director of Personnel Services. I have been in this position since December. But like Veronica, I have been in the San Leandro Unified School District for a while now. I think this is going on my 22nd year here with SLUSD. So when and if you get ready to make that decision to retire from SLUSD, the form that you see on the screen is the form that you will fill out. You can find it on our website when you go to our website under Employee Portal. And then when you look on that page, you'll see retirement/resignation form. And that would be the form that you would use. So we have made it simple and easy for you to find. So thank you.
Just to point out, there's a difference between resignation or leaving the district in retirement. You can do one without the other, right? You can leave the district, you could resign when it's time to move on, but not necessarily apply for retirement with CalSTRS. So I just want to make sure those are two separate processes or two separate procedures. Sometimes, a lot of times come at the same time, but not necessarily for everybody. I want to just have a little disclaimer here, like you typically see with financial workshops. CalSTRS can be pretty difficult to understand in some of their minor nuances or small nuances that can have major implications down the road. So just make sure that you contact CalSTRS for the most accurate, up-to-date information regarding your personal pension, your personal situation. This presentation is meant for a resource. It's really not meant to be an official guidance from CalSTRS. We're passing along information that we've picked up over the years and from publicly available information, but CalSTRS itself is the organization that would be able to give you a final answer on any particular personal questions. Retirement system and options. So first of all, let's talk about what the retirement systems are. CalSTRS, where the money comes from for CalSTRS. You know that when you look at your paycheck every month, there's about 10% that comes off the top that goes straight to CalSTRS each month that you work. The employer, in this case, the San Leandro Unified School District, is also paying about 17% of your salary each month to CalSTRS. And then finally, the state, a lot of people don't know, the state is also kicking in about 6% of your salary each month to CalSTRS. So those are the three sources where money is being given to CalSTRS. On top of that, CalSTRS invests your money, and its return on investment actually is about 2/3 of all of the funding that CalSTRS gets is from those long-term investments, stock market, real estate, etc. CalSTRS is what's known as a defined benefit program, a DB program. That's your main program. That's versus a defined contribution program. Typically in the private sector, what you'll see is a defined contribution where you know how much the employer is giving, how much the employee is giving, and then how much you end up getting in retirement is just based on how the stock market does or how those investments do over time. What a defined benefit does is it sort of flips that, where it says, we know how much you're going to get. What you get is based on a formula, right? So that formula is what really makes CalSTRS kind of this golden program that I want to show you how special it is and how important it is and how well it can treat you in retirement, because it's that defined benefit versus a defined contribution program. There's also something called the Defined Benefit Supplemental, DBS program. It's a small ancillary account we'll talk about a little bit in a while. But you can find your DBS amounts on your annual statement that you get from CalSTRS, but I just want you to understand the difference. DB is the main one that you want. DBS is all your money to take at the end, but I'll show you where those DBS, those defined benefit supplemental dollars come from. There's also Social Security. CalSTRS members do not participate in Social Security. So certificated teachers in the district, certificate administrators, no Social Security. You don't pay 6.2%. The district doesn't pay 6.2% for you. All you're basically getting is CalSTRS. Just want to make that clear. Classified members of the district, they certainly do pay into Social Security, and then they could expect that in retirement. Just want to make that clear. Jim Edgar is going to talk a little bit later about some of the differences. There are some kind of unique circumstances where CalSTRS members can get Social Security, can participate in Social Security, but it's not common. And that was a decision that was made years and years ago, decades ago, by members of CalSTRS at the time, I think in the 50s. Medicare is another program that everybody does participate in. You pay 1.45% of your salary into Medicare, and the district matches that. That's a requirement. And Medicare is essentially what it does is it gives you reduced cost health insurance once you turn 65 years of age. Decades ago, CalSTRS members did not pay into Medicare, but since the 1980s, the mid 80s, they do. So everybody's required to be in there. We've had people call and say, hey, I don't want to do Medicare because I have my healthcare elsewhere, my spouse or whatever. And we have to say, no, that's different. This is not paying. This isn't your current health insurance. This is your future health insurance. And it turns out to be a pretty good deal for everybody. And then we'll talk about tax sheltered annuities are also options as part of a retirement system. Tax sheltered annuities are known by their IRS code. That's why there's numbers associated with these. And these are all employee funded, all money coming from, all money coming straight from the employee out of your paycheck if you choose to participate in these. I'm going to ask Jim to kind of go over these quickly. The first one is just a brief overview of a 401k, which you've probably heard of.
Yeah, 401ks are offered by the public sector, and they function the same way, pre-tax up to $19,000, and then you get a $6,000 catch-up. So if you're over 50, you can put up to $25,000 in a 401k.
And that should be private sector, right?
Private sector.
Yeah, private sector only. So we're not private sector. So you'll hear about 401ks, but we're not eligible for 401ks. Instead of 401ks, we have 403Bs.
Now, 403B can be either a investment account, a managed account, or it can be an insurance product. So San Leandro has a tremendous list of different options for us to work with you on.
And again, that's nonprofit or governmental school, and that's both of us. That's us. So that schools are possible for this. And then on top of 403Bs, we have 457s.
Teachers and school district employees are the only ones that have the ability to do both a 403B and a 457. In the early 2000s, the government said that you could participate in both. So that means that you theoretically could max out both of the 457 and the 403B. The difference is the 457 is only liquid when you leave the district. The 403B is liquid at 59.5. So that's the difference between the two offerings.
So slight differences with those. For most purposes, there's really no difference other than you could stack these if you were so inclined.
Yep.
Right, to max out both of those. And then finally, there's this Roth option, a Roth 403B and a Roth 457.
Yeah, we don't have a Roth 457, but we do have a Roth 403B. So what the IRS says is for your whole 403B, both Roth and traditional pre-tax, it's a total of $19,000. So theoretically, you could put $10,000 in a Roth and $9,000 in a traditional 403B for a total of $19,000. And that's post-tax dollars in the Roth that grows tax-free. That's the whole reason for doing a Roth 403B.
Right, so growth tax-free. So when you're ready to retire, when you're ready to draw on those dollars, none of it is subject to income tax.
That's right. You can take it out, spend it with no taxes.
Right. So those are the programs. That's essentially the retirement system and what the options are. Let's talk about pension reform, because there's two different systems in place now for CalSTRS. Back in 2012, the state passed something known as PEPRA, which was intended to address unfunded pension liabilities. Unfunded or underfunded pensions happen when there's the pension has to pay out more than it has on hand. So it owes more than it's expected to take in. So CalSTRS is having trouble with that, where it's underfunded. It didn't have enough money in the system. PEPRA was passed to help address that. PEPRA stands for Public Employee Pension Reform Act. Anyone joining CalSTRS or any public pension after January 1st, 2013, it's subject to PEPRA. When PEPRA first came out, they started using the word old and new to refer to that, but they quickly realized that's not good to, you're not going to call some people old and some people new. So they had to come up with different terms with that. What CalSTRS uses is the 2% at 62. It's a little confusing, but 2% at 62 is for PEPRA membership. So if you're PEPRA, 2% at 62, and you have to think of when did you first become a teacher? When did you first join CalSTRS? That's your membership date. And then classic membership, or the original membership prior to January 1st, 2013, is known as 2% at 60, right? 2% 60, 2% 62. So impacts of PEPRA, a couple things, several things that it did. It made some changes. Final compensation is based on the highest 3-year average salary instead of the single highest year. It imposed a creditable compensation limit. That basically means your maximum salary that you can count towards CalSTRS. For this year, the limit is $151,837, and that adjusts annually. If you're a teacher, there's no problem with that. You know, almost every teacher is going to fall under that limit for it. But as people move into different positions, maybe into administrative positions and whatnot, that's something to keep an eye on. But again, that only applies to 2% at 62 members. There's a 180-day sit-out rule after retirement before, if you ever want to come back into a teaching assignment for subbing or things like that. And it clarified what types of pay do and don't count towards creditable compensation. And there's several other small adjustments that came with it, but those are the main ones from PEPRA. But despite these changes, again, CalSTRS remains a robust system that really benefits California teachers. And people don't think of it, they don't realize it, but it's really one of the main drivers of what makes teaching such a special profession, right? So let's talk about, before thinking about retirement, you should now, today, log in to the pension website, mycalstrs.com. Make sure that you have an account with that system. Pay attention to the annual service credit. Every year you get a statement in the mail, you'll get one emailed to you. It's available to you on the website. Make sure that you pay attention to that annual service credit. It's always important to look at that you get a 1.0 service credit. That's your years of service every year. You should go up by 1.0. There's no issues with that. It can be really difficult to address questions later in life. And some people try to go back, wait, in 1992, I had some problem where there was some leave and I didn't get a 1.0 and trying to fix those. It's really difficult to do at that point. So keep up on it, keep an eye on it. Let me see. Here's what the website looks like, the main website. And right there in the middle, there's something called View Your Retirement Progress Reports. And over on the right-hand side is what comes up. You can go into any of those years. In this case, anything from 2020 back to 2002 is available on the mycalstrs.com website. I know a teacher who at some point ended up having worked for several districts, and one of the districts had somehow submitted a Social Security number incorrectly. And CalSTRS ended up having 2 different accounts for the person in question. And she had to work really hard to get those 2 accounts back together. All of those years, all of those little fractional decimals really make a difference in pension down the road. So keep an eye on this. If there's one piece of advice that you walk away with, check the mycalstrs.com, check your totals, make sure you keep up on it. Let's see, the retirement calculation, when it comes down to it, is pretty simple. We talked about this being a defined benefit system, DB system. There's 3 things involved. There's service credit, how many years you work. There's an age factor, how old you are when you retire. And there's a final compensation amount. What's your final salary when you retire? So those are the 3 things to keep an eye on. If you think about it, service credit, you have control over. You determine when you retire. Do you go part-time? Are you full-time? Do you take leaves of absence? Things like that. That's what's going to help with your service credit over time. Age factor, when the age, again, that you decide to retire. So you have total control over that. The final one, you have some control over for final compensation to determine, again, if you're full-time, how much are you adding different degrees? Are you adding stipends? Things like that that can count towards, that may count towards final compensation. But those are the three factors. So keep those three in mind. We'll talk about those a little more, show how all of those work together to figure out your final retirement benefit. I have a couple videos here that I want to make you aware of. They're both on YouTube. There's a CalSTRS 2% at 60 video to walk through this, and there's a CalSTRS 2% at 62 video. And I'm going to go ahead and show this. It's just under 5 minutes. I'm going to go ahead and show this for us. Just checking on time here. And then you'll be able to just Google any one of these videos. But this is kind of an easy way to view, to see how that formula works for you before we delve into it a little more. Can you hear it okay?
Hi, I'm Rachel, a member of the CalSTRS team. If you became a CalSTRS member on or after January,
Kevin, you need to share sound.
you're under the
It's a little low.
Senate 62 benefit structure, which determines how your retirement benefit is calculated. CalSTRS administers a hybrid retirement plan for your financial security. Your comprehensive package includes a traditional defined benefit program, a cash balance defined benefit supplement program, and a voluntary defined contribution program we call Pension 2. As a vested member of the CalSTRS defined benefit program, you're entitled to a guaranteed lifetime monthly benefit when you retire. This benefit
Oh, sorry.
CalSTRS 2% at 62 benefit structure,
I won't touch it.
which determines how your retirement benefit is calculated. CalSTRS administers a hybrid retirement plan for your financial security. Your comprehensive package includes a traditional defined benefit program, a cash balance defined benefit supplement program, and a voluntary defined contribution program we call Pension 2. As a vested member of the CalSTRS defined benefit program, you're entitled to a guaranteed lifetime monthly benefit when you retire. This benefit is based on a formula, not on how much you've contributed. Let's look at how your benefit is calculated. The calculation is made up of three factors: your service credit, your age factor, and your final compensation. Now let's take a closer look at the three factors. Service credit is the number of full and partial school years you have worked and contributed to CalSTRS since becoming a member. Full-time employees generally earn 1 year of service credit for each fiscal year, which is the maximum a member can earn in a school year. Part-time employees earn service credit based on the percentage of each full-time contract they work. For example, if you work 50% of your full-time contract, you should earn a half year of service credit. You can keep track of your service credit by logging on to My CalSTRS to review your annual retirement progress report. You should address any service credit discrepancy directly with your employer. Age factor, the second component of the formula, is the percentage determined by your age at retirement in years and months. For example, if you're 62 years and 6 months of age at retirement, your age factor would be 2.067%. The maximum age factor is 2.4%, which is reached at age 65. You can find the age factor table in the CalSTRS member handbook. Final compensation is the last factor of the formula. It's your highest average compensation earnable for 36 consecutive months. It should be noted, however, there is a cap on the annual compensation earnable used to calculate this portion of your benefit. The amount of the cap changes every school year, so be sure to check the latest CalSTRS member handbook to determine if and how this compensation limit may affect you. Let's take a look at an example of how to calculate final compensation. and $64,000. CalSTRS adds these amounts together and divides by 36. Gina's final compensation is $5,545.83. Now let's see how the three factors of the formula work together to determine Gina's monthly retirement benefit. If Gina retires with 26 years of service credit at age 62 years and 6 months, with an age factor of 2.067%, and with a final compensation of $5,545.83, this will give her a lifetime monthly retirement benefit of $2,980.43. Gina can increase her monthly retirement benefit by increasing any one of the three factors of the formula: her service credit, her age factor, or her final compensation. For example, by working just one more year, Gina will increase her service credit to 27 years and boost her age factor from 2.067% to 2.2%. These two additions to the formula increase Gina's initial retirement benefit by over $300 per month. To see how working longer or increasing your age factor or final compensation can increase your own lifetime retirement benefit, use the retirement benefit calculator on CalSTRS.com. For additional information on how final compensation is calculated, please see the CalSTRS Member Handbook, available online by clicking the Publications link on CalSTRS.com. While you're there, register for My CalSTRS to access and manage your personal information online, anytime. Start making plans for your future.
All right. Let's see. Okay, we're back. All right, I like that video just because it's nice and simple and easy and walks you through those steps of what that is like. Let's see. I want to go back here. So service credit, let's walk through those, all three of those items here. Service credit, generally 1 year of work gives you 1 year of service credit. You want to review your statement yearly. We've talked about that. You can't get more than 1 year of service credit annually. STRS credit for summer school, an additional period, somebody who teaches that 1.2 FTE, or additional hours worked after school, they show up in that DBS, that defined benefit supplemental account. It's hours above that 1.0. And more on service credit. What's important, something else to walk away with today is an understanding of sick leave. Your sick leave is converted into service credit when you retire. So if you end up with any sick leave at all, it counts towards you and it helps your service credit number. CalSTRS retiring members submit something called an express benefit report. And you could just Google express benefit report CalSTRS and you find the form. Payroll completes that form once you send it in after the final June attendance is submitted, and it sends it to CalSTRS to say, here's the number of days that you ended up with in terms of sick leave. There's a copy of the form available in the presentation. And an example, if you're a teacher that after a career of teaching, you have 130 unused sick leave days, those don't go to waste. They definitely count for you. The way the calculation works is it's 130 days divided by your calendar year. For SLTA members, it's 186-day calendar year or work year. So 130 divided by 186, which is just a hair under 0.7. So that 0.7 would be added on to your service credit at the end of, for retirement. So it's then a benefit that counts for the rest of your life, right? Ongoing benefit to you. That's an important one. Transfer of sick leave, it's a liability, it's a cost, but that's also built into the employer rate. So when we're paying CalSTRS, that monthly amount, that's included in our rate that we're paying, that the district is paying for every CalSTRS member in the district. It's not just created, it's actually paid for already on your behalf. Let's look at age factor. This is a bit of a simplified table. There's tables with more detail because every month your age factor is going to go up, but these show just the years on them. And this is again from that CalSTRS handbook that they talked about. You can find the link here in the presentation. You can see that for 2% at 60 versus 2% at 62, it's exactly like it sounds. At 60, that age factor is 2%. At 62, that age factor is 2% for the 2% at 62 members. You can see that the differences here with PEPRA, the rates went down just a little bit from 1.4 to 1.16, or you can see that it maxes out here 2.4 at age 63 versus 2.13% at the same age for PEPRA employees. It's also important to note that these have maximums. 2.4 is the maximum that you reach at 63 versus 65 for 2% at 62. So when you're doing the sort of the calculation about when am I going to retire, what age, keep that in mind. It's at a certain point that age factor doesn't go up any higher. A little benefit here for CalSTRS members under that 2% at 60, the classic membership. There's a career factor of 0.2% is added to your age factor if you retire with at least 30 years of earned service credit. So somebody 61 and a half is kind of a classic age to retire because you would be at 2.2%. Adding on that 0.2 brings you up to the maximum is 2.4. So essentially for people with 30 years of credit, once you've passed that 61 and a half year threshold, you can't go any higher for age factor. I want to point that out. Final compensation calculation can be a little bit complicated. Again, CalSTRS can give you, a counselor could give you that official final compensation. 2% at 60 just uses the highest 12-month period. 2% at 62, like in the video, uses the highest 36-month period. New rules have been introduced to control spiking. There were some people that were trying to game the system a little bit. That's called spiking, when all of a sudden you have a big bump in your compensation in the final year. And that's really been ruled out under PEPRA. Some additional compensation counts towards final compensation, some doesn't, and it's a bit complicated to go through. But things like a master's degree stipend would, or a special ed stipend, or department chair stipend, things like that, where it's part of your workday. Those definitely do count towards your highest compensation. They're creditable compensation. Let's see. CalSTRS, Defined Benefit Supplemental. This is the DBS that we talked about. This is the contributions, again, above that 1.0 year of service credit. They're credited at 8%. So 8% of your money goes into these accounts for any earnings above your 1.0 service credit. DBS balance, it's included on your annual statement. So you can always look this up to see what amount you have in your DBS account. It's your money on retirement, right? There's none of this, it's yours. So you can take it in a lump sum, or you could draw it out over time. Whatever you choose to do with it, the DBS money, it's all yours. One possible strategy is if people retire before the age of 65, sometimes they look at the cost of healthcare until Medicare kicks in. Something that people can look at is using DBS dollars to help fund those additional healthcare costs until the age of Medicare. And a quick sample 2% at 60 retirement calculation. So we're going to the 2% at 60, not 2% at 62 that was in the video. Here's an example of a teacher at age 61 with 30 years of service credit. So if you look on the age factor table, 61 years of age, the age factor is 2.13%, but there's also this career factor of an additional 0.2%. So the number works out, 2.13 plus 0.2 is 2.33. Highest compensation, just for example, purposes here, it's $108,000, which equates to $9,000 a month for 12 months. And the calculation is 30 for 30 years of service times 0.0233 for that age factor times $9,000 a month gives you $6,291 per month. One of the important measures there is, well, how does that do compared to what I was making? 6,291 divided by 9,000, it's about 70%. So it replaces 70% of your original salary there, right? But if you look at that, that seems a little bit low, but remember that CalSTRS and Medicare are not deducted once you retire. right? CalSTRS isn't deducted from your CalSTRS pension. So once you factor those out, you're really much closer. 88.3% is equivalent to 100% because you're not paying those additional dollars out. If that makes sense. So 70% is 18% different than what you'd really be taking home or what you'd be making your taxable income prior to retirement. So that's the way the calculation goes. You can kind of see where that's an important calculation to understand how much it is that you're going to need or how much you think you're going to need down the road. Is the mortgage paid off? Are the kids out of college? Are there other expenses? Are there other big ticket items that your big expenses that aren't coming out of your paycheck every month? Let's see. Post-retirement. Griselia, I think you were going to do this one if you're on here. We just want to go over the rules real quick about post-retirement again.
So post-retirement, thinking that you might want to come back into teaching after retirement. So there is a sit-out period, right? It's right there, the 180 days sit-out period that you can't return for 6 months after retirement. And so there's a period of time. There are some very limited exceptions to that sit-out period. And then there is a earnings limit for the post-retirement. And so for 2021, it was $47,713, but that increases every year. So that retirement earnings increases. And the limit is for credible school-related services.
Right. And it's $1. So you want to make sure that when you retire, sometimes people come back and substitute. If you're subbing occasionally, there's no problem with that. Sometimes you see people come back and get hired. You just want to make sure that you don't go above that, whatever the earnings credit is at that point, because it's a dollar for dollar loss. Every dollar you make over that earning credit, STRS takes $1 away from you. So it's a pretty big penalty for that. Let's move on and we'll talk a little bit more about tax sheltered annuities. And I think this is Veronica's going to help me out with this part. Oops, you're muted, Veronica.
So employees can sign up for tax shelter annuities through payroll deductions. Deductions can be before or after tax. And we use TSA, our tax sheltered annuity consulting group. And there's no charge to the employee, and they just kind of administer to make sure that we are in compliance with the IRS, not just for the employee, but for the employer as well. And Jim will go over a little bit more about, how we can sign up for these annuities.
Got it. And that's an important one. The IRS component is an important one. Nobody wants to get hit with fines or fines or penalties for deducting too much in terms of those limits. Let's see, how do I begin TSA? And Jim, I have you signed up for this one. If you could just walk us through this. If you're a teacher in this district and you want to sign up, you don't know the first thing about it, how do you go about signing up for a TSA?
Very easy. If you don't have a financial advisor, you can go to the website 403B Compare, and that will give you a list of current district vendors, and you can contact them. And the TSA is the organization that tells the school district what you want to deduct. So they have electronic interface that you can increase, decrease, stop, start your contributions. And it's basically how it works. You establish your account and you decide how much you want. And if you need to change it, you can do it electronically. So no more paper, which is great.
And I'll just show you real quick. We have a list here from our website. This is all of our current vendors that we work with. And we're always happy to put more vendors. We'll just go through the agreement process. So the agreement has to be specifically with the district, but there's an awful lot of companies out there that do it. Jim said there's currently some Roth 403Bs. There's no Roth 457s, but Jim, that doesn't mean that there couldn't be if somebody wanted one, right? We could create one.
Easy.
Easy peasy. Okay, for that, let me go back
Now,
into
Kevin, one of the things that they need to understand about that list is some of those on that list are grandfathered and are not active for new investments.
Right. Some of them have been around for a while, but it is a complete list. There's ways to get a hold of theirs. You could lots of ways. Jim is one of the people that will set you up with these, but there's any number of people, number of companies that will do it. Jim's just somebody that we work a lot with, a lot of people in the district.
For instance, New York Life, if you have an existing 403B with New York Life, you can continue it, but New York Life is not participating in any new 403Bs with San Leandro.
Also, it's all online, much easier than it used to be. There's a process here to go through that online salary reduction to sign up here for it. And again, that's something that Jim, if you choose to go through Jim could help you with. But TSA Consulting Group has a nice online portal to make this easy to track and easy to manage at this point. Let me see, I'm gonna go ahead back in here and go back into the presentation. So that we walked you through how to set up a TSA. And that's the end of the first part of our retirement system. Those are the major overviews for the district. Why don't we open this up to questions here? Timing is we're doing fine on timing. Does anybody have any burning questions you want to ask? And we'll see what we can do. Elena is first.
So my question is, when I go to CalSTRS and I go to the calculator to calculate how much money I would receive when I retire, there's the annual service credit years, right? Right below that, there's the other service credit, and it's 0 to 5, it says. And I'm not sure where to, what qualifies for those service credits?
That's a good one. STRS used to let people buy what was called airtime, where you could actually just buy additional years of service credit, just here's money. And it was always expensive to do. They don't do that anymore after PEPRA. They don't let you buy airtime. Jim, do you know the answer to that?
Yeah, that's exactly what it is. It's airtime because it doesn't affect your longevity, but it gives you credit for the years that you bought back.
Okay. So I supervise new speech therapists, and I work, I've supervised maybe 4 or 5, and I get a 1.0. So I get a 1.0 for the year, and then I get a 0.1.
You're a 1.1. Yeah. So you're 1.1 right now. 1.0 is the most you can get each year in service credit. That additional 0.1 goes towards the DBS account. So you'll see that credit in the DBS account. And there's a little nuance to that. STRS makes us charge the entire 1.1 or whatever the extra hours are, summer school, et cetera, at the full STRS rate. But then after the year is ended, they send money back to us. The difference between that 10% and the 8% that you're credited as, so 2% is sent back to us, and then we send that back to the employee. So once a year, you'll see on your paycheck something about STRS excess contributions is what that is. It's all by design, but that's the money coming back to you, the difference between the 10% STRS and your 8% that you're actually credited at. So the extra 0.1 unfortunately does not help you in terms of service credit, but it does help you in terms of the defined benefit supplemental account.
Okay, and I can find that. You went over that, but that's on the CalSTRS page.
CalSTRS, yep, that is, yeah. Any other burning, maybe just one or two more burning questions here before we move on to the next part? If you want to take a stretch break, it's a lot of information.
I have a quick question.
Oh, go ahead.
Emily, go ahead. And then Gianna.
I have to miss the next part, but I was wondering whether this will be offered again next year so that I can pick up on. Yeah,
that's a great question. So a couple things. One, Keziah is recording this. So I'm on my best behavior right now because it's all being recorded. She's going to edit out my initial comments. And we're looking at posting it. We do want to make this a recurring thing. And also, if you have questions, please feel free to reach out to Jim Adgar. He can drop his, Jim, do you want to just chat your email address?
Yeah, it's on the
screen.
screen, and it's jadgar@planmembersec.com. And you can email me and I'll answer your questions or help you in any way I can.
So all of those things for you, because this is important. And then Gianna, did you have a question? Then we'll move on to the second part.
Can you change your or adjust your amount that you want to put into your 403s or each year? Can you change that amount?
Yes, you can stop, start, increase, decrease at any time.
Up to the maximums, and the maximums right now are $19,000 normal, and then there's a catch-up provision above the age of 50, which is, I believe, 26,500.
26,500, yes.
Yep.
Now the caveat is we have to have the changes in prior to the end of the month of the prior month. So if you wanted April's paycheck to be changed, we would need to have March, by the end of March, the change made so that TSA can tell the district that your next paycheck you want changed.
Great. And here, I'll just pull up this 403B Compare website. Is that the right one?
Yes.
403B Compare is a website from CalSTRS, and this is the one that's going to help if you want to look at different products and whatnot, the one that Jim mentioned earlier.
Yeah, I'm on this all the time.
With that, again, if you welcome, I'm hoping people stay, but if you aren't going to stay for the entire presentation, Jim is going to talk now about additional, more detail on the tax sheltered annuity side of things. So with that, I'm going to launch back into full screen here. And we're going to move into, let's see, deeper look at tax sheltered annuities. So Jim, you're on.
So this presentation is called Financial Wellness for Today's Professional. And we're going to talk about the basics of plan participation in the 403B and 457. And I want to welcome you to this presentation. And my name is Jim Adgar. I am a financial professional with Plan Member Securities, one of the authorized investment providers of your district. And I've been working with San Leandro employees since 2004. So I have a long history with San Leandro, and it's a great district. I specialize in helping individuals plan and invest for their retirement. The process of retiring, as we just looked at, can be a bit overwhelming and is sometimes scary for people when it scares them from getting started. But I'm here today to help you understand the basics of retirement plans and stressing the importance of participating in your plans. And at the end of this presentation, give you an opportunity to develop a comprehensive plan to help you achieve your retirement goals, because everybody has different needs and so forth. So next screen, Kevin. Okay, this is a general information only and does not intend to provide specific investment advice or recommendations for any individual. It is suggested that you consult your financial advisor for legal and tax and financial services. Plan Member Securities Corporation makes no representation as to its accuracy or completeness. The use of diversification asset allocation as part of your investment strategy neither assures nor guarantees better performance. There may be surrender charges imposed during the first 5 to 7 years that you own a fixed annuity contract. Withdrawals prior to age 59.5 may result in a federal penalty in addition to any ordinary income tax. Although it is possible to have guaranteed income for life from a fixed annuity, there is no assurance that this income will keep up with inflation. The tax deferred feature of an annuity should not be a factor in purchasing an annuity in a tax qualified plan. That's very important because there's no reason to put money in annuity unless it's going to do something for you. That tax deferral is already provided by the plan, and the tax deferral of the annuity does not provide any additional benefit. Annuities are subject to additional fees and expenses to which other tax qualified funding vehicles may not be subject. Individuals should only purchase an annuity in a qualified plan with its other benefits, such as lifetime income payments, family protection through death benefits, and or guaranteed fees meet their current needs. Plan Member Securities Corporation is not associated with or endorsed by the Social Security Administration or any government agency. This seminar presents a general overview of certain rules related to Social Security, and the ideas presented are not individualized for your particular situation. This information is based on current law, which can be changed at any time. Okay, we got the legalese out of the way.
That was a lot of legalese.
I'm
All right.
required. So, agenda, why you need to save, how Social Security and the state retirement system works together, voluntary savings plans, the basics of 403B and 457, and getting started and the cost of waiting. Now, it is more important than ever to develop a solid retirement plan. The news is full of articles about how unprepared baby boomers generation is for retirement. During this presentation, I hope to share some valuable information that you can use immediately to help you plan your retirement. These include why it's important that you save for your future, how Social Security and your CalSTRS retirement system work together, the role of employer retirement savings plans like your 403B plan, how a 403B plan works, its tax advantages and other features, how to get started, and how waiting to save could cost you a bundle. Now, make sure we all understand the 403B is synonymous with the TSA. So let's not get hung up on 403B or TSA. The TSA is specifically an annuity. The 403B could be any other investment other than an annuity. Next slide, please, Kevin. So why do you need to save? The simple fact is that your standard of living in retirement absolutely depends upon it. Social Security replaces only approximately 40% of an average earner's wages. When we're talking about that, we're talking about a couple that may be a teacher and a spouse that is not a teacher that has Social Security. Educators and older individuals receiving benefits through their state retirement system typically receive benefits that cover a higher percentage of their income, but there is generally still a significant gap they must cover with personal savings. And the other thing that we have to remember is inflation will slowly erode your CalSTRS benefit. We all know inflation, it is constantly there, making the money that we have less valuable. In the future, the situation is only going to get worse. Without major reform, most estimates put the Social Security system bankrupt by 2037. What that means to you is that while benefits won't necessarily go away, they could be reduced. So next slide, Kevin. Okay, before we talk about how to fill these gaps, let's take a moment to discuss your state retirement system and how it works. We've already talked about the benefits that are generally based on your retirement age, years of service, and final compensation. Eligibility to begin receiving benefits is generally based on age and years of service. Kevin's already done a good job of detailing that. In most cases, employees eligible for state retirement benefits usually are not eligible for Social Security benefits. Next slide. For those of you who are eligible for Social Security benefits, full benefits begin at your normal retirement age. This is defined by the IRS and takes into consideration the year you were born. You can choose to take delayed benefits and receive an 8% increase in benefits for each year they are delayed. You can also take your benefits beginning at age 62, but payments will be reduced by a fraction of a percent of each month before normal retirement age. I have had teachers retire and look at their Social Security, and if they're eligible for Social Security, they can get Social Security, but their Social Security is run through what is called a windfall elimination provision. And what that means is IRS calculates your CalSTRS and your Social Security, and based upon those two factors, will reduce your Social Security. We want to at least get your Social Security to cover your Medicare. So that's something I can talk to you if you're concerned about Social Security and Medicare and all that. I can explain to you how that works. But everybody's situation is unique, so we have to understand that. If you are eligible for Social Security, you will get something from Social Security. You have to be eligible though. All right. So this is kind of telling you about Social Security. So next slide, Kevin. Okay, the role of employer savings plans. As we identified earlier, neither the state retirement system nor Social Security are the sole answer to meet 100% of your retirement needs. There may be gaps that will need to be filled in order to maintain a financially healthy retirement. To fill those gaps, we need to focus on savings because as life expectancies continue to grow and pension benefits shrink, our personal savings will need to last longer and provide a larger portion of our retirement income needs. So what type of supplemental savings plan can help make up the difference? One of the best ways is your district's 403B plan. Next slide. So exactly what is a 403B plan? Let's take a quick look at some of the basics. IRS Code 403B plan is the primary voluntary retirement plan for employees of public schools and other nonprofits. By law, all employees working a minimum of 20 hours per week are eligible to participate in the plan. Contributions to the plan are made through automatic payroll deductions on pre-tax and after-tax Roth basis, and the investments can be made through a plan investments grow on a tax-deferred basis. You can begin taking penalty-free withdrawals from your plan account beginning at age 59.5, or for qualifying hardship situations. For individuals who turn 70.5, well, that's 72 now, in 2020 or later, you are required to begin taking minimum annual distributions from your account. Your account assets are portable in the event of employment changes. That means you can consolidate your money with a new district or roll it over to an IRA. You can invest your plan assets in the investment choices through the plan's approved providers. We've already been through that, and we've shown you the different providers on 403B Compare. Next slide, Kevin. What is a 457? I think we skipped. Here we go.
Skip it?
Yeah. So, okay, let's go with 457.
Okay. Oh.
Okay. Pre-tax contributions, the basic. The basic. Okay, the next one after that, how does the plan work? Okay. How do plans work? The easy systematic way to save for retirement. Your plan contributions are automatically deducted from your paycheck through district salary reduction agreements. You control that. You can stop, start, increase, and decrease at any time. It can be invested in mutual funds and or annuity products you choose from the plan's approved investment providers. The plans provide a variety of tax advantages, which we will discuss in a moment. You can transfer assets between employers if you move from district to district. Tax advantages. Next screen, Kevin. To encourage you to save and help your savings grow faster, the 403 plan offers a number of powerful tax advantages. One of the primary tax advantages is that plan contributions can be made on a pre-tax basis. This means that your payroll contributions are taken from your paycheck before income taxes are deducted. They can help reduce your current income taxes and allow you to contribute amounts to the plan that are greater than the reduction in your paycheck. These advantages are illustrated here in this simple table showing a hypothetical 300 payroll contribution. Notice that by contributing 300 to a plan, taxes are reduced by $75. Also notice that although 300 was contributed to the plan, take-home pay was reduced by only $225. So you could say that the pre-tax contributions, it costs less than $1 to take home pay to contribute $1 to the plan. So you're saving taxes. That's the most important thing. In California, we have state and federal taxes. While pre-tax contributions provide some savings advantages, Uncle Sam does eventually get his cut when pre-tax contributions and earnings are taxed upon withdrawal. Next slide. The advantage then is that we have after-tax Roth contributions. Your employee's plan also allows after-tax or Roth contributions taken from your paycheck. What's important to understand here is normal Roth IRAs can be limited if a family unit has excessive earnings of, say, $180,000. The ability to fund a Roth IRA is eliminated at that point. Because the Roth 403B is an employee benefit, there is no income restrictions on funding a Roth 403B. And if you are allowed to do a Roth IRA, you can do a Roth 403B also. They're not eliminate each other. So that's important for people. A lot of people think if they do a Roth IRA, they can't do a Roth 403B. There's no limit on that. While Roth contributions receive no upfront tax advantage. All investments earnings accumulate tax-free, and withdrawals are free from income taxes. The tax-free withdrawal feature makes Roth contributions ideal for those who will most likely be in a higher tax bracket in retirement. There are also no required annual minimum distributions of Roth contributions and earnings if they are rolled into a Roth IRA prior to age 70.5. This provides more flexibility when constructing a retirement income strategy and the potential to pass more along to your beneficiaries. Next slide, please. Regardless of whether you make pre-tax or Roth plan contributions, all investment earnings accumulate tax-free. What that means is that you grow your account, there's no taxes due that year. Eventually, if you take money out of your traditional 403b, you will pay taxes on that. This provides a significant growth advantages over non-qualified taxable accounts where taxes are due each year on income and realized capital gains. So how does Uncle Sam get his cut? Normal income taxes are due on qualified withdrawals of pre-tax contributions and investment earnings. For Roth contributions and earnings, there are no taxes on qualified withdrawals since Roth contributions are made after taxes. So let's take a look at what makes up qualified withdrawals. Next slide, please. Qualified penalty-free withdrawals from 403b accounts generally can begin as early as 59.5. What that means is you can be employed, and if you needed money out of your 403b, you could take it out even if you're employed. So there's no restrictions on it once you hit 59.5. In addition, penalty-free withdrawals prior to age 59.5 can also be made for hardship, disability, death, and divorce settlement. Withdrawals taken for any other reason are subject to a 10% federal tax as well as possible state penalties. In addition, any withdrawal of pre-tax contributions and earnings, penalty-free or not, is subject to normal income taxes. Next slide, please. Plan portability. Any money you contribute to your employer's plans, the investment earnings can on your contributions as well as any vested employer contributions and earnings are always 100% yours and are portable should you terminate service with your employer. This does not mean you simply take your assets in cash. If you do that, then you'll be subject to taxes and a federal penalty if you're under age 59.5. Or the 457 plan participant separating from service. To avoid possible taxes and penalties, you can roll your investment over to your next employer's 403b, 457, or 401k plan, or to an IRA. So time is your most important asset. Next slide, please. These are two savers, and one saver starts saving at age 21, puts $3,000 away for 15 years and then stops. So that's $3,000 annually. She puts a total of $45,000 in the account. She stops at age 36. Hypothetical saver Jim starts at age 36 and saves the same $33,000 through his whole career. His total investment is $90,000. Lisa's total investment is $45,000. If they maintain their accounts, Lisa has more than almost doubled his account totals. So starting early, even with a small amount, can make a huge difference for you when you get to retirement age. It's an amazing feat. That's very important. Next slide, please. This is if we were doing it personally, so you can go to the next one. And next slide, Kevin. So questions, you can visit me, my personal website, which is at planmember/jadgar, or you can send me an email or call me, whatever you'd like to do. Veronica has my number, and she'll be glad to provide it. Kevin, we can open up for questions if you want.
Yeah, let's go ahead and do that. Let's just to do a quick time check. We had scheduled 3:30 to 4:30. We're a little bit past that, but I appreciate everybody sticking around to hear this important information. Are there any just burning questions that you think everybody would want to hear? Or again, you have options to work with Jim or any financial advisor individually on that, now that you have a little more information. But anybody that has a burning question, please go ahead and unmute and let's hear it.
Hi, it's Cynthia Tam here.
Hi, Cynthia.
Hey, I had a question about 403 and 457. I remember rolling my information over to another company, and they said I couldn't roll over my 457.
And
I don't know what that
Jim,
means.
I have the same thing going on where I have a 457 with a previous employer, and they're saying it's because it's employer specific. It's still there, but it has to go for a certain number of years before you can roll it into something else, like a 10-year.
Well, actually, Kevin, it depends on the vendor, and I really wouldn't recommend rolling 457 if you separate it from service, because you then give up the liquidity feature of the 457.
Oh, sure.
Because right now, if you needed money, you could take that 457 and use that money and just pay regular taxes on it. Whereas if you roll it into another 457 with your current employer, you lose that liquidity feature.
Oh, okay. So just keep it where it's at.
I would definitely recommend that. But if you want any help, obviously I can help you with that or answer other questions.
Okay, thank you so much.
Okay.
Thanks for the question, Cynthia. Anybody else? Any last minute questions?
Just a quick clarifying question. So we can have that 19,500 limit on the 403B and a 457. So you could have like, not, this is obviously a lot of money, but you could invest 19.5 in each. Is that correct?
That's correct. Absolutely.
Okay.
Yeah. And then over the age of 50, you have over
even
50,
more.
Yeah, you could go to $54,000, almost $52,000 over the age of 50 is a catch-up provision for both of those. And again, part of the reason that we work with all districts always have these consultants, TSA Consulting Group in our case, is to help manage that, because that does get a little bit complicated from IRS reasons, but just again to make sure that nobody gets in trouble for withdrawing too much.
Yeah, they monitor contributions every month and every year to make sure that we're staying compliant.
Last question. We have time for one more.
Hey, just thanks for the time. I was wondering, like, in terms of CalSTRS, in like the retirement at 1%, 2%, those numbers, like what happens if a member, say, leaves the profession or leaves California and is no longer contributing to their CalSTRS, but then comes back to teach in California and is a CalSTRS member again? Like, how does that impact, say, when that person can retire and start receiving their benefits?
So a couple things on that. One would be, if you were to leave CalSTRS employment, let's just say you stop teaching altogether, stop teaching in California. What some people do is cash out, and you'll hear these sort of nightmare stories about people that take the money out of CalSTRS, because they'll give you your contributions back. What they don't give you is the larger district contributions, state contributions, and those return on investment funds, right? Which is the much bigger part of it. So you hear people cash out and take those and then decide to go back into teaching later. And, it's a big hassle at that point. So my just personal sort of preference recommendation would be don't ever cash out of CalSTRS. It is possible, and Jim could talk more to that, if you move to another state with another retirement system, there's a bit of portability to it, where there's some work where you can move from one system into another system. Jim, you're a bit familiar with that, of how that
Yeah,
works.
I'm real familiar with that. If you're vested,
which is 5 years, 5 years to
of service, right, with CalSTRS, and you left your money in CalSTRS, your age factor continues to go. You're just not adding additional years of service to the plan. So now you're out of the state for 10 years, and you happen to move back and you become a teacher again. Your membership is still there, and you just start adding new money to it or new years of service.
Yeah.
What I have seen in the past is people take their money, come back 10 years later, and now they have to put in 4 times as much because of the future value of money. So you may have taken $15,000 out, and CalSTRS says now you're older, you have to put in 50 or 60 or 70 or even more. It's called a redeposit, and it's very, very challenging to do that.
Yeah, and I've known a couple of retirees who did that early on in their careers in the 70s. They were going to leave teaching and, you know, cashed out for what was probably a few $1,000s at the time. Ended up the cost of that over time is probably hundreds of thousands of dollars to what they would have gotten in a lifetime of pension. So always want to think long and hard before ever taking money out. It's going to sit there and work for you regardless once you're vested again at that 5-year mark. Yeah. Well, I want to thank everybody for participating. After a long day of teaching, a long year of teaching and work, it's good to just take some time for you and learn more about this and some of the ins and outs of the pension system and how all of this works. So want to, again, thank you for your time. You have a number of resources and information in front of you, and feel free to reach out to any one of us and we can make sure that we point you in the right direction. So thank you, everybody.
Thank you.
Thank you.
Bye-bye. Have a great rest of the week.
Thank you.
Thanks.